Stock market outlook for 2023. The predictions of the top finance experts. What could happen in the bond market this year that we haven't seen before? This is what we find very interesting and exciting. Given recent events, the challenge of this task is that almost any prediction, from a market crash to bull markets and another tech bubble, is justified. Give yourself a fresh start by investing in this asset class that's historically performed well in tough times. The S&P 500 will finish down more than 17% in 2022. Some analysts claim 2023 could be a much better year for stock. If you're toying with the thought of playing the market and think you can pick a cycle or play some strategy that will allow you to beat the market, welcome back to the Ring of Knowledge, your trusted source of practical financial knowledge. Today's video will discuss the predictions of the top finance experts about the stock market. What's the outlook for the stock market in 2023? The Federal Reserve Bank's final major statement of the year, which discussed interest rates in the United States, did little to contribute to the spirit of the holiday season. Indeed, the Federal Reserve cut back on its planned interest rate hike, bringing it down to 0.5% from the 0.75% rise it had planned after each of its previous 4 sessions. On the other hand, some of this may have been due to the desire to avoid shocking markets already prepared for a price decrease. The current advice suggested that interest rates may now climb to 5.1% next year, which is much higher than the 4.6% that was forecast as recently. The fight against inflation, both in the United States and elsewhere, is likely to be the primary focus of market participants as we go into 2023. The question of when interest rates will peak and at what level will they do so has yet to be resolved. The point to take away from all this is this: despite the rise in the cost of borrowing money, consumers and the labor markets have shown to be more resilient than most people anticipated. However, it still needs to be determined whether increased interest rates are having the desired effect of reducing demand considerably. The data on retail sales in the United States have been volatile throughout the summer, and a 0.6% drop in November needs to be seen from a 1.3% growth perspective. Consumers are still reeling from the effects of the pandemic and are probably not in the mood to be coaxed back into a life of moderation and frugality at this point. But in the coming year, growth may come less from consumers than it has. The personal savings rate in America, which is a measure of how much people are saving from their extra money, has dropped from a record high of 34% in April 2020 to just 2.3% now. A similar pattern is starting to emerge in the UK. The savings rate hit a record high in 2020 and is now back to its historical average. Domestic consumer spending, which makes up more than 2/3 of all US and UK economic activity, will be in the spotlight in the new year. If consumers finally give in to higher interest rates after putting it off for a while, a recession is almost certain to happen. It still needs to be clarified how much of this will lead to lower inflation. High inflation must be caused, at least in part, by supply stocks. China's policy of getting to zero CO2 emissions has slowed down the world's second largest economy. It has also made it harder to get things to the West. The same could be said about the war in Ukraine, which has hurt the economies of both Western and Eastern Europe by making people less confident and making it harder to trade with other countries. One of the potential outcomes in 2023 is that the conflict in Ukraine hastens, or it is the impetus for increased engagement from the West, which would likely result in a further increase in inflation. For investors, the options available in 2023 may come down to concentrating their efforts on those countries and regions in which inflation and interest rates have developed into a significant problem, with the goal of acquiring assets at prices significantly reduced before conditions significantly improve. Another way to look at this is to consider the possibility that some of the assets that have performed the worst so far this year could end up being some of the best performers in 2023. There is growing optimism that inflation and interest rates can head downward as economies slow down. Government bonds and technology stocks have suffered losses due to the rising inflation and interest rates this year. The financial markets have already accounted for a significant portion of the possibility of a recession occurring in 2023. Because of this, there is space for improvements in confidence and market activity in the event the news turns out to be less severe than it was feared. This is likely primarily because stock markets recover from a crisis much earlier than economies and corporate earnings. Slow growth, lower inflation, and new monetary policies will help bonds, defensive stocks, and developing markets in 2023. When inflation and several of these years' other significant market movements reverse course in 2023, investors may experience a case of whiplash. In 2022, when there was robust economic growth, high inflation, and hawkish policy, the markets face a drastically different scenario from the one in 2022. In general, 2023 will be an incredible year for investing in items that bring in money. If global macro trends keep inflation low and central banks stop hiking interest rates, bonds, which had the worst performance in 2022, might have the most outstanding performance in 2023. This is especially true for bonds of excellent quality, which, historically speaking, have done quite well after the Federal Reserve have stopped hiking interest rates, even when a recession was followed closely behind it. Trends point to high-yield equity. Equities, on the other hand, will continue to be volatile next year, and the S&P 500 will end the year close to where it started, at around 3,900. Consensus earnings estimates are just too high, to the point where we think companies will hoard labor and see operating margins shrink in a very slow-growing economy. To do this, investors should look at the high-yielding parts of the stock market, like consumer staples, financials, healthcare, and utilities. Investing in European stocks could have a small upside, with a 6.3% total return expected by 2023. This is because lower inflation causes stock prices to rise. This should more than make up for the 10% drop in earnings per share we expect from weaker top-line growth and big margin disappointment, claims Graham Secker, head of European and UK equity strategy. He claims that financials and energy are more likely to do well in this environment. The return of bonds. Interest rates are expected to go down in 2023, which is good news for stable and appealing bonds because prices move in the opposite direction of yields. Morgan Stanley's fixed income strategists predict that German bonds, Italian government bonds, and European investment grade bonds will all have high single-digit returns through the end of 2023. The same is true for U.S. Treasuries, investment grade bonds, municipal bonds, mortgage-backed securities issued by government-sponsored agencies, and AAA-rated securities. But investors should pay close attention to the quality. High-yield corporate bonds from the U.S. may look appealing, but they may not be worth the risk during a potentially long default cycle. We are worried about unfinished business with high yield, claims Vishy Terapatar, the Global Director of Fixed Income Research. This is especially true for securities backed by agency mortgages. Not only are they the most liquid asset, but they also have the best value to begin with. The last time mortgage spreads were this wide in the fourth quarter of 2018, claims Terapatar. Goldman Sachs predicts flat returns until 2023. This year, inflation reached levels not seen in the previous 4 decades. Financial markets hailed signs that the Federal Reserve may soon draw back on increasing interest rates, as falling prices could allow for less aggressive policies. During the preceding month, Goldman Sachs reports that the S&P 500 has seen a gain of 3.2%, while the Dow Jones Industrial Average has a gain of 4.52%. One Goldman Sachs strategist, Christian Muller-Glissman, warns that the current upswing won't last forever and that several conditions must be met before the market may reach the bottom. Muller-Glissman stated that without depressed values, investors need to witness a peak in inflation and rates, or a trough of economic activity, for markets to trough. The growth-inflation mix remains unfavorable. Inflation is likely to normalize, but the global economy is declining and central banks are continuing tightening, although at a reduced rate. Muller-Glissman continued by saying, the valuation starting point has improved, but values of hazardous assets are substantially above recessionary levels, and earnings are expected to be skewed to the downside in the coming year. Emerging markets in Japan are quick to recover. This has been a terrible bear market for emerging markets, but Jonathan Garner, Chief Asia and Emerging Market Equity Strategist, claims the tide might be turning. Valuations are low and cyclical winds are shifting in favor of emerging markets as global inflation falls faster than expected. The Fed stops raising rates and the US dollar falls, he claims, adding that in the last few economic cycles, emerging markets have recovered before US markets. Investors should keep an eye on mid-cap and large-cap companies. The MSCI EM, an index of mid and large-cap companies in 24 emerging markets, could gain 12% in value in 2023. The Tokyo Stock Price Index could gain 11% next year due to the low evaluations and unexpected tailwinds for Japanese stocks. EMEM debt could be another bright spot if many things happen, like rates going down, the economy improving, and the dollar weakening. Fixed income strategists predict that emerging market debt will have a total return of 14.1%. A 5% excess return will drive this, and a 9.1% contribution from a falling U.S. emerging local market currency denominated debt should see an even better total return of 18.3%. Mike Wilson of Morgan Stanley forecasts double-digit stock drops in 2023. It's about the way. I mean that no one cares about what will happen in a year. They must figure out what to do for the next 3 to 6 months. We think there are a lot of bad things about that. So 3,900 seems like a boring way to spend 6 months. No, it's going to be a crazy ride. Wilson, the firm's chief U.S. equity strategist and investment officer, thinks the S&P could fall as much as 24%. At some point in the first 4 months of the year, the S&P should be between 3,000 and 3,300, he claims. That's when we think the slowing down of changes to earnings estimates will kind of reach a peak. The S&P 500 closed at 3,957, a 17% drop from the beginning of the year. Wilson's year-end price goal for this year was also 3,900. He also claimed the bear market is not over. If our earnings forecasts are right, our lows are much lower than we thought. The biggest companies, not just tech companies, by the way, is where most of the damage will be done. It might be a consumer, it might be a factory, Wilson claimed. When those stocks were having trouble in October, people put their money in these other areas. So part of this rally has been caused by people moving their money around. Wilson's prediction comes after earlier warnings of fast money to sell off stock. In July, he claimed that the low in June was probably not the end of the drop. The 52-week low for the S&P 500 was 3491 on October 13th. On the other hand, Wilson does not believe himself to be a fully grown bear. This is not the time to sell everything and run for the hills, because that's probably not until the earnings come down in January and February, he added. Wilson anticipates constructive headwinds will push stock prices higher over the next few weeks. It is our responsibility to organize these strategic gatherings. I think we've got this one figured out, remarked Wilson. I believe this tactical rally is legs towards the end of the year. Investors need to be aware of the risk that the ideas given may no longer be applicable or have already been put into action. The impact that shifts in currency exchange rates will have on investments made in other nations is something that can't be avoided. Compared to investments in other developed economies, the risk associated with investments in emerging markets can be higher. The issuers of bonds may be unable to repay the money that they have borrowed, or the interest that has accrued on the money they have borrowed. This is one of the risks associated with investing in bonds. An increase in interest rates may harm the value of bonds. If interest rates keep climbing, there is a chance that the value of your investment will go down, which puts you in a precarious financial position. The selection does not represent a personal recommendation to buy or sell a specific fund and should not be interpreted as such. The information presented here should not be interpreted as a recommendation from the author for a particular type of investment. Suppose you are still determining whether an investment is suitable for you. In that case, you should discuss the topic with one of your professionals at Fidelity or an approved financial advisor to determine whether the investment is acceptable for you. So that's all for today's video. If you like this video, click the like and the bell buttons. We'll have another video for you soon. Take care until then.